Warsh did not give this market the easy Fed pivot it wanted. Welcome back to the daily market update for July 1st. My base case is cautious, buyers still have room, but they have to prove this is only a pause, not the start of a bigger giveback. The mechanism is simple. When the Fed keeps the inflation target firm and refuses to guide the next meeting, yields stay in control. Softer jobs and softer factories help, but only if the bond market believes the inflation pressure is cooling too. So sellers need yields to push back up and hit growth again. Buyers need the data to look slow enough for Fed flexibility, but not weak enough to become a recession scare. That is the line I am watching before the first SPY chart. The macro evidence matters first because today gave us slower labor, softer manufacturing, and still enough price pressure to keep the Fed careful. ADP private payrolls rose by 98,000 in June below May, so hiring is cooling without sending a collapse signal. The payroll comparison puts 98,000 against a 92,500 consensus and 122,000 before, so traders see slower hiring, not a broken labor market. ISM manufacturing slipped to 53.3, still above the expansion line, but weaker than May and weaker than expected. The prices paid index dropped hard from May, but at 73, it is still high enough to stop a full rate cut celebration. That makes yields the real judge here, because lower yields give QQQ and Nvidia room, while firmer yields punish long-duration growth fast. The BLS metro numbers add the backdrop, with local labor markets mixed rather than clearly hot or clearly breaking. I think the evidence helps stocks only mildly here because it eases some Fed pressure but still leaves yields in charge of the next trade. The Dow Jones Industrial Average finished basically flat, slightly red, and that tells me defensive buyers were present but not strong enough to lead the tape. The S&P 500 slipped about 0.2%, so broad buyers gave back a little ground instead of confirming a strong risk push. The Nasdaq Composite lost roughly 0.2%, and that is the pressure point because growth is still most sensitive to the yield debate. VIX eased into the mid-16 area, so fear did not spike, and that gives buyers some room as long as price does not start breaking support. Bitcoin rose a little more than 2% near 60,000, so speculative demand did not disappear, but it also did not rescue the equity tape. Now we start with SPY, because the first question is whether the new quarter is just taking a healthy pause, or whether sellers are starting to turn this into a real risk-off reset. SPY still has the bigger uptrend argument, but I would not treat this as a free chase after the first half run. 30 years monthly log channel is the first warning point here because price is stretched away from a very long-term trend path. June 2026 monthly close above the upper rail is the confirmed signal, and it is the second monthly close in a row outside that channel, so this is not just a random daily push. Expensive edge of the channel is where I get cautious, because SPY is already far enough outside the structure that I do not want to blindly chase strength up here. Back inside the channel would not mean an instant crash, but it would tell me the market is choosing either a faster pullback or a long sideways grind instead of easy continuation. RSI is around 72.6, so the market is stretched, even if stretch alone does not force a reversal. Let me quickly switch to MACD because momentum is positive, but the lines are also at record highs for this monthly window, so the trend is strong and late at the same time. The shorter-term picture is more supportive than that long-term stretch makes it look. Bullish RSI divergence is already playing out, with price making a lower low while RSI refused to confirm it, and since that second pivot, SPY has already rallied about 4.6% over 3 bars. So for me, this signal is no longer about predicting the turn. It is about whether buyers can keep the reclaimed momentum and avoid turning the bounce into another failed push. That fits the current macro mix too. Softer ADP and cooler ISM help the market breathe, but Warsh keeping the inflation target firm means buyers still need price to prove the Fed pressure is already absorbed. The tactical call is still continuation first, but only while this structure holds. Price is above both major moving averages, and the 50-day has held for 3 sessions, so the broad market has not broken its trend cushion yet. 50 days moving average is the line I care about most here, because losing it would make this bounce look a lot less durable. Support resistance structure has price near the upper end, so buyers are close enough to press higher, but also close enough to get rejected if participation stays weak. RSI is near the 50 line, so momentum is balanced rather than strongly directional, and that means price action has to do the confirming. MACD is still slightly negative, but the histogram is improving, so selling pressure is cooling instead of accelerating. Volume overlay is the caution flag here because the 5-day average volume is in the bottom 20%, so the push is happening with unusually light participation. Market staying above this area keeps the continuation path alive, but a clean fallback under the breakout area would turn this from a healthy pause into a failed break risk. That is why QQQ matters next. If tech can hold up while yields stay contained, SPY gets a better chance to turn this cautious pulse into another controlled push. QQQ is the leadership test after SPY, and I am more cautious here than I was in the broad market. Price is still above both major moving averages, so tech has not broken trend yet, but this is not a strong breakout setup. 50 days moving average has held for 59 sessions, and that is the line buyers cannot afford to lose if the AI trade is going to keep supporting the tape. Support resistance structure has price sitting around the middle, not pressing cleanly through the upper side, so I still lean toward rejection first. RSI is near the 50 line, which tells me momentum is balanced, not strong enough to give buyers a free pass. MACD is still slightly negative, but the histogram is improving, so selling pressure is cooling rather than accelerating. Market can still get pressed lower from here, unless buyers reclaim the upper structure with force, and Warsh keeping the Fed path data dependent makes that harder for long-duration growth. A clear upside reclaim would flip my tone quickly, but until then QQQ is telling us the AI rally still has to pass the rate test, and that puts the next focus directly on yields. TNX is the pressure point after QQQ, and my read is that yields are still strong enough to keep growth stocks on a leash. The 10-year yield is trading inside a rising trend channel, in the upper half of a structure that has been working since October 2025. SMA 50 is sitting near 4.45 as support, so this is still a yield buyer area, not a confirmed rate breakdown. RSI has reclaimed 50, so momentum is shifting back toward yield buyers, even though MACD is rolling over and pushing against the bullish yield bias. That matters because Warsh kept the Fed tied to inflation credibility, while ADP and ISM were soft enough to slow the economy but not soft enough to force a clean dovish pivot. The upper band near 4.56 is a level that keeps the yield trend in control if buyers push there and hold. A rejection from that upper area would open a pullback toward the midline around 4.46, and that would give SPY and QQQ more breathing room. But the structure is tight, with daily ATR around 30% of the channel width, so once range expands, this can move fast. For equities, the message is simple. If TNX holds this channel and rotates higher, the broader bounce gets harder to trust. If yields reject and fade, the dollar becomes the next check on whether risk appetite is really improving. The dollar is the risk appetite check after yields, and right now it is not giving stocks a clean green light. Trend channel battle upper is the key spot here because the dollar pushed above the upper boundary intraday, then slipped back inside by the close, finishing right on that upper line. Trend channel battle upper deepest tells me this has not been a clean one-way breakout, with only 2 channel breaks since early January and the largest closing excursion around 0.8%. Trend channel battle upper reclaim close is the decision I care about next. Holding the upper band near 101.21 keeps the dollar trend in control, while rejection opens a pullback toward the midline around 100.02. RSI is above 50 and rising, so short-term momentum still favors dollar buyers, and the MACD histogram rolling over supports that bullish dollar bias. That matters for the equity thesis because a firm dollar usually means tighter global liquidity and less room for a broad risk chase. If the dollar keeps holding this upper boundary while yields stay firm, I would not trust an easy SPY or QQQ breakout. If the dollar rejects back toward the midline, risk appetite gets more breathing room, and then Nvidia becomes the cleanest test of whether AI leadership can actually use that relief. Nvidia is still the cleanest AI leadership check, but the news flow is not enough by itself to save the chart. Palantir rallied after announcing a sovereign AI partnership with Nvidia, so the platform story is still getting real demand signals. Evercore also reiterated Nvidia as an outperform idea, and recent European AI supercomputer headlines keep the infrastructure theme alive. But with yields and the dollar still firm, the market is asking a harder question. Can Nvidia hold leadership when high-growth valuations are under pressure? Price is below the 50 days moving average but still above the 200-day, so the short-term read is softer while the bigger AI trend has not fully broken. 50 days moving average is the first reclaim level, and until buyers get back above it, I treat rallies as repair attempts, not leadership control. 200-day moving average is still the deeper trend floor, and a continued pullback toward that line would make this a much more serious test for the AI trade. Resistance is the area that flips the tone if buyers can close above it, because right now this is not a clean breakout setup. Support still matters because rejection risk stays elevated, and a move back toward the middle or lower side of the structure would push against the broader bounce case. RSI is still below 50 and fading, so momentum has not repaired enough for me to call this a leadership reset. MACD is slightly negative, but the histogram is improving, so selling pressure is cooling rather than accelerating. My read is cautious. NVDA can still help the market if it reclaims resistance, but right now, rejection risk is still the bigger threat. That is why the calendar matters next, because the next macro reaction has to either give AI room or expose this as another failed leadership bounce. Let's have a look at the calendar for next week. After Nvidia, this is where the whole AI and yield setup gets tested. Thursday, July 2nd is the big one, with average hourly earnings month over month, average hourly earnings year over year, and non-farm payrolls all hitting at the same time. The payroll estimate is 110,000 versus 172,000 before, so traders are already looking for slower hiring, not a hot labor market. The wage numbers matter just as much, with monthly earnings expected at 0.3% and yearly earnings expected at 3.5% versus 3.4% before. The question is simple. Does this jobs report help buyers, or does it give sellers another reason? If payrolls are firm without wage heat, that can help stocks because recession fear cools down without pushing the Fed harder. If jobs or wages come in too hot, that is not good for stocks because yields can jump and high-growth names like Nvidia get hit first. If labor cracks too badly, that is a different problem, because then the market stops trading Fed relief and starts trading growth fear. We do not need a perfect number. We need an event reaction that does not scare the bond market and does not make the AI weakness look like a bigger demand problem. Personally, from what I am seeing in the news, I think traders are underestimating how hard this jobs report can move the tape. The full market message is still bullish enough to respect, but not strong enough to chase blindly. Again, the broader trend is still alive, but the next close matters more than the first intraday push. The main setup is a controlled push higher, but only while buyers keep defending the current support structure. The overhead decision zone starts around the falling resistance line near 746, and that is where I do not want to see a quick tag and fade. The upper Bollinger area near 758.7 is close enough to matter now because strength can turn into stretch fast once price presses into that band. RSI at 54.2 is not extreme, so the market is not washed out, and it is not in a classic blow-off either. That helps the bullish argument, but MACD is rolling over above the zero line, so buyers still need to prove this is a pullback, not the start of a larger stall. Again, the macro story does not replace the level. Warsh kept the Fed focused on inflation credibility, while ADP and ISM cooled enough to stop a clean hawkish shock. That mix gives buyers some room, but only if yields and the dollar do not push back again. Primary support around 739 is the line in the sand for me, because holding it keeps pullbacks corrective first. Below primary support around 739, the tone changes fast, because then sellers are not just cooling the tape, they are starting to break the active read. Again, price can keep pushing higher, but I would not blindly chase it into overhead resistance without a firm close. For me, the uptrend only starts reasserting itself if buyers push into resistance and still look firm by the close. Let's extend this read a bit and see how price could build from here. The path I am tracking first is a controlled move back toward the upper resistance cluster, because the broader structure still leans higher above support. The resistance cluster around 760.4 is the next real supply test, and buyers need to absorb that area instead of just spiking into it. The upper Bollinger Band at 758.7 sits right under that same zone, so I want stability there, not a fast rejection. If buyers can hold control through that resistance area, the larger upside objective only starts to come into view around the measured move target at 8 on 18. Again, that 8 on 18 objective is not active just because it exists. It needs a confirmed hold and follow through above resistance. If that fails, the cleaner risk path is a pullback into the first support cluster before buyers get another real chance. The support cluster around 738.9 is the first shelf buyers need to defend if sellers reject the move from resistance. Support there is not automatically bearish if buyers defend it cleanly. It can still be a normal reset inside the larger trend. If that first support shelf breaks too, the deeper support cluster around 724.4 becomes the next downside reaction area. That is where I would expect the bearish path to stall or bounce unless the market starts breaking much harder than this evidence supports. So the final question is simple. Do buyers hold 739 and push towards 760, or do we reject first and test 724 before the next real attempt? That is the daily market update for July 1st. Watch 739 on the downside, respect the 760 area on the next push, and do not chase until the close proves buyers still have control. Thanks for watching, stay sharp, and I will see you in the next market update.